Hello, and a big welcome to this discussion, brought to you by the team at Pro Tax Accountant. We're about to pull back the curtain on a question that affects millions of people across the UK, but it's one that's often wrapped in a bit of mystery. We're talking about the data that HMRC, the tax office, shares with the Department for Work and Pensions. And, more importantly, what does it all mean for you and your money? So, let's just cut straight to it. Is the government checking your paycheck, looking at your savings, and keeping tabs on your financial life without you even knowing? The short answer is yes, absolutely. And it's happening constantly. This automated, behind-the-scenes data sharing has very, very real consequences for your benefits and your wallet. Okay, so let's dive into how this all works. Over the next few minutes, we're going to break it all down. We'll kick things off with the legal agreement that makes this whole thing possible. Then we'll look at the tech that's zipping your data around. After that, we'll get into the real-world impact on your benefits, what happens when the system messes up, and we'll finish with the most crucial part, how you can protect yourself. First up, the data sharing agreement. Now, it's really important to understand that this isn't some random snooping. It's a formal, legal arrangement between two of the most powerful government departments in the UK, and it's all designed with some very specific goals in mind. So, why do they do it? Well, the official reasons are all about making the system more efficient and fair. The government wants to double-check that people are getting the right amount of benefits, they want to catch fraud and those costly overpayments, and just generally make the whole machine run a bit smoother. It's also used to track what you earn for tax and national insurance, and even to collect on debts you might owe to the government. And you should know, this is all perfectly legal. It's backed up by major laws like the Digital Economy Act and the Data Protection Act. So there are rules. But, and this is a big but, just because there are rules doesn't mean the system is perfect. The way these rules are put into practice can have a massive impact on your life, as we're about to see. So, how does this actually work on a day-to-day basis? That brings us to Section 2, the data superhighway. This is the nuts and bolts, the technology that carries your financial information from your employer straight to the tax office and then directly over to the DWP. The engine of this whole superhighway is a system called real-time information, or RTI for short. Put simply, every single time your boss runs payroll and pays you, they have to send a digital report with all your pay and tax details directly to HMRC. This has been the law for all UK employers since way back in 2013. And wow, this table really shows you the sheer amount of data we're talking about. It's not just your salary in real time. When you file your tax returns, information on your self-employed income, interest on your savings, investments, even rental income, all of it gets shared with the DWP. Just maybe not quite as often. This might look a bit technical, but the key thing to take away is this. It's not a live, constant video stream of your finances. Think of it more like this. A few times a day, the DWP sends over a shopping list of national insurance numbers to HMRC. And 4 times a day, HMRC sends back a data package with the latest earnings info it has for those people. It's fast, it's automated, and it happens every single weekday. That's not all. Here's where most people go wrong. Let's get into how this data sharing can have some very real and often really problematic consequences for your benefits. This is where the digital efficiency that's so great for the government can cause absolute chaos for you. Right, here is the absolute core of the problem. Universal credit is calculated in a rigid, fixed monthly period. But who in the real world gets paid perfectly once a calendar month? Almost no one. You might be paid weekly, every 2 weeks, or every 4 weeks. And this mismatch is where the whole system just grinds to a halt. It's like 2 gears with different teeth trying to connect. It just doesn't work. And this picture illustrates the problem perfectly. If you're paid weekly, then 4 times a year, the DWP's monthly assessment window is going to catch 5 of your paydays instead of 4. If you're paid every 4 weeks, once a year, it'll see 2 paydays. The DWP's computer just sees this, thinks you've had a massive pay rise, and boom, it can drastically slash or even stop your universal credit, forcing you to start the whole application process over again. Let's make this real. Meet Alex, a freelance designer in London. They get paid every 2 weeks. Because of how the calendar dates fall, twice a year, their universal credit assessment period scoops up 3 of their paychecks instead of the usual 2. The automated system just sees this as Alex earning a double salary, and the result? Their universal credit payment is stopped, dead. They get a notification saying their income is too high, and they're thrown into a panic, full of financial stress, all because of a system that can't handle a normal pay cycle. Stay with me, the next point might surprise you. Because this is the truly frustrating part. As you can see right here from HMRC's own software, they know your pay frequency. The system literally asks employers, do you pay weekly, 2-weekly, or monthly? That crucial bit of data, the one thing that could solve this entire problem, is collected by HMRC, but it's completely ignored by the DWP system when it's calculating your benefits. The inflexibility is literally built into the system. And it's so important to understand this isn't just a universal credit problem. Oh no, the very same data feed can mess with pension credit for pensioners, it can trigger stressful reviews for people on disability benefits like PIP or ESA, and it can even reduce your council tax support. It is a system-wide issue. Now, let's look at the next step. What happens when the issue isn't a flaw in the system's design, but when the data is just plain wrong? What if your employer makes a mistake, or the system gets your details mixed up with someone else's? So if the data is wrong, there's an official disputed earnings procedure. But the key thing to see here is that the system puts the entire burden of proof on you. You have to prove the government's official data is wrong, not the other way around. You're basically treated as wrong until you can prove you're right. So what should you do if you find yourself in a dispute? Okay, first, the simple stuff. Double and triple check your national insurance number is correct everywhere. A simple typo can cause absolute chaos. Second, log in to your HMRC personal tax accounts online. This lets you see exactly what data they have on you. Third, and this is so important, if HMRC's data is wrong, you must get it fixed with them first. Correcting it at the source is vital. Only then should you go to the DWP with your evidence like payslips and bank statements to prove your case. And here's a pro tip for you. That HMRC personal tax account is an incredibly powerful tool. By logging in, you can see the very same earnings record that HMRC is sending over to the DWP. You don't have to wait for a problem to pop up. You can get ahead of it. Make it a habit to check it regularly, just to make sure all the data is accurate. And now for the most important part, how you can be proactive and stay ahead of any potential problems. In a system that is so automated and inflexible, being prepared and knowing your stuff is truly your best defense. This quote from Med Confidential's research really just sums it all up, doesn't it? The real-time information system is a massive benefit to the government for collecting data, but when it goes wrong, all of the harm, all of the stress falls on the individual. This is why being informed and being vigilant isn't just a good idea. It's absolutely essential. So what are the best practices? First, if you have any big changes in your life, your income, your savings, anything, report it to the DWP immediately. Don't wait for the system to figure it out. Second, like we said, check your national insurance record online regularly. Third, know the rules about savings. For a lot of benefits, having savings over £6,000 will start to reduce your payment, and over £16,000 usually stops it completely. And finally, if you're self-employed, it is absolutely vital that the monthly income you report to the DWP matches up with what you eventually file on your tax return. Believe me, they will check. So we'll leave you with this question to think about. Now that you know your financial data is constantly and automatically being shared between these huge government departments, will you manage your finances any differently? Are you going to be more proactive in checking your records and reporting changes? Look, trying to navigate this system can be really daunting. If you need expert help with a tax dispute or you just want to make sure you're doing everything right, you can contact the experts at Pro Tax Accountant. All their details are on the screen now. Thank you so much for your time. And for more insights like this, make sure you subscribe to the channel.